What if I told you that being a great investor isn't about picking the next moonshot? In fact, according to the world's greatest investor, Warren Buffett, it's about something much simpler. He has two famous rules. Rule number one, never lose money. And rule number two, never forget rule number one. But wait, the market goes up and down every day. Does he mean you can never see a red day? Not exactly. To understand rule number one, we have to look at the brutal math of loss. Imagine you start with $100. You take a big risk and the investment drops by 50%. You now have $50. A tough blow, but you think you can make it back. Most people think they just need a 50% gain to get back to even. But here is what happens. 50% of $50 is only $25. You're still short. To get back to your original 100, you need a 100% gain. That's the asymmetry of loss. Losses are twice as hard to recover from. This is why Buffett prioritizes the return of capital over the return on capital. In the world of investing, your money is your inventory. If you lose it, you're out of business. Think of it like a snowball rolling down a hill. As it rolls, it picks up more snow, getting bigger and faster. This is compound interest, earning interest on your interest. But if that snowball hits a rock and shatters, you have to start all over again from the top with a tiny speck of snow.
Rule number one is about protecting the snowball. Studies show that the biggest factor in long-term wealth isn't the highest returns. It's how long you can stay invested without being forced to sell. Take the story of Ronald Read. He was a janitor and gas station attendant. He never had a high-paying job. He never won the lottery. But when he died at age 92, he had over $8 million. How? He followed rule number one. He bought blue-chip stocks and never sold. He didn't chase hot tips that could go to zero. He avoided the permanent loss of capital. Compare that to many high-earning celebrities who go bankrupt. They make millions, but they take massive risks and lose it all. They broke rule number one. They let the snowball shatter. So, how do you actually apply this in the real world? It starts with the margin of safety. Buffett says, if you build a bridge that carries 10,000 pounds, you don't drive a 10,000-pound truck across it. You build it to hold 30,000 pounds, but only drive the 10,000-pound truck. In investing, this means buying an asset for much less than it's worth. If you buy a house worth $500,000 for $300,000, even if the market drops a bit, you haven't lost your initial capital. You have a cushion, a margin, a safety net.
The second part of rule number one is staying within your circle of competence. Only invest in what you actually understand. If you don't understand how a company makes money, you can't tell when it's at risk. And when you don't see the risk, that's when you lose money. Buffett famously avoided tech stocks in the late 90s. Everyone else was making a fortune. He looked like he was falling behind. But he didn't understand them, so he stayed out. He protected his capital. When the bubble burst in 2000, those fortunes vanished overnight. Buffett was still standing because he followed rule number one. Another key is managing your emotions. Meet Mr. Market. Every day, Mr. Market offers to buy your stocks or sell you more. Some days, he's incredibly happy and prices are high. Other days, he's depressed and prices are low. Rule number one means you don't let Mr. Market's mood dictate your actions. If you sell just because the price went down, you've turned a temporary paper loss into a permanent one. That is the ultimate violation of rule number one. Buffett also uses a baseball analogy. He calls it waiting for the fat pitch. In baseball, if you don't swing at 3 strikes, you're out. But in investing, there are no called strikes. You can stand there for years, watching thousands of opportunities go by. You only swing when the perfect, low-risk opportunity comes right down the middle. Patience is a form of risk management. By not swinging at bad pitches, you ensure you don't lose your capital on mediocre ideas. Now, you might ask, is it even possible to never lose money? Of course not. Even Buffett has lost money on specific trades. He lost billions on Dexter shoes and Kraft Heinz. But rule number one isn't about being perfect. It's about a mindset of defense. It's about avoiding the knockout blow.
If you have 10 investments and 9 stay flat while one goes to zero, you've lost 10%. But if you have 10 investments and you protect your capital so none go to zero, even a small gain across all of them will lead to massive wealth over time. This is why diversification is often called the only free lunch in finance. By spreading your money across many assets, you reduce the chance of one mistake breaking rule number 1. So, here is your actionable takeaway for today. First, stop looking for get-rich-quick schemes. They are rule number 1 traps. Second, focus on high-quality assets with a proven track record. Third, always ask, what is the downside, before you ask, what is the upside? If the downside is losing 50% of your net worth, the upside doesn't matter. Fourth, build an emergency fund. This is your ultimate rule number 1 tool. If you have cash set aside, you won't be forced to sell your stocks during a market crash.
You can afford to wait for the market to recover. Fifth, invest in yourself. Buffett says, your skills are the only asset that can't be taken away. Inflation can't take your talent. A market crash can't take your knowledge. That is the safest investment you will ever make. Remember, the goal of investing isn't just to make money. It's to keep the money you make and let it work for you forever. Most people fail because they get greedy and break the rules. They try to turn $1,000 into $1 million in a year. In the process, they turn $1,000 into zero. Don't be that person. Be the person who protects their capital. Be the person who respects the power of compounding. And most importantly, be the person who remembers rule number 1. Investing is a long game. It's a marathon, not a sprint. If you stay in the race, you win. But to stay in the race, you have to keep your shoes on and your feet moving. Keep your capital safe. Avoid the big mistakes. And let time do the heavy lifting for you. That is what never lose money actually means. If you found this helpful, hit the like button and subscribe for more Doodle Finance. I'm the Doodle Investor, and I'll see you in the next lesson.